Okay, I think we're probably going to have more people showing up, but we will just go forward and they'll have to jump in. Welcome to the SCORE webinar, Understanding Cash Flow. When you're in business, nothing is more important than cash flow. Without it, you don't pay the bills. SCORE is a national organization that puts on these kind of webinars. Our chapter here in the upstate represents all the counties in the upstate, so we're responsible for that. Our mission is to help people start small businesses or grow businesses. We do that through one-on-one mentoring or workshops and our resources. And if you visit our website, piedmontscore.org, piedmont.score.org, you'll find more resources than you can ever use. You're fortunate tonight to have Rich Clays here as your presenter. Rich has been an upper-level financial manager for many years, for manufacturers, distributors, service companies. He recently retired from a very large distribution company where he was the CFO. So without further ado, we'll get started. Here's Rich Clays, and if you have a question, please use the chat feature, and we will monitor that, and we'll get a chance to ask the presenter your question. Okay.
Thank you, Terry. And as Terry said, if you have questions at any time, use the chat feature, and we'll try to answer those questions as we do the seminar. As Terry said, I'm a retired senior financial executive, currently help some small businesses in a consulting basis as their CFO or as a senior financial advisor. So let's get into it now. Understanding Cash Flow, a Business Survival Guide. Basic thing, without water, you'll die. Without cash, your business will die. As Terry said, cash flow is the key to a successful business. A profitable business can run out of cash to fund operations. That is a profitable business. You can have excessive inventories, overdue receivables. You can have poor practices with regard to sales. You can make bad investment decisions. You could buy equipment that you don't need, or you can also pay out on small companies. You can pay out dividends to the owners too aggressively and not have enough capital. And a business can fail when it's profitable with significant growth. And we'll talk about that in a bit. So significant growth, profitable growth, can be a problem for cash flow. If you have high cash flow or very good cash flow, your company is able to generate cash to pay its bills and perhaps to help afford your growth. If you have low cash flow, you may have to borrow or issue equity securities, get additional owners to help pay your bills. Again, earnings and cash are not necessarily the same. Poor cash management has been and can be a stumbling block for entrepreneurs. Understanding cash flow will help you plan for the growth of your business. Profit is the money that you expect to make over time. Cash is what you must have on hand to keep your business running. So one of the assumptions that I'll make today is that your business is on the accrual basis of accounting as opposed to the cash basis of accounting. The accrual basis of accounting is when you record a transaction at the time you incur the liability or you incur the transaction. The cash basis is when you record a transaction when the cash actually flows. An example that I use in another seminar that we do is a credit card. So on the accrual basis, when you swipe the credit card, that's when you'd record the purchase of whatever it is, the service or the goods that you're buying. But on the cash basis, you wouldn't record that until you actually paid that credit card bill. So that's an important distinction. Some of you may be on the cash basis. This is still an important, very important seminar for you, or webinar, But on the accrual basis, it actually makes it a little bit more difficult to understand cash flow if you're looking just at accrual basis. Profits do not always mean that you have cash on hand. So as sales go up, cash can go down. Cash can be invested in inventory as your sales are going up in anticipation of more sales. Your receivables, even if people are paying on time, your receivables can be growing. You may need new infrastructure and additional employees as your sales are going up. You may need an additional location. You may need additional assets, additional equipment, and you certainly may need additional employees, additional sales employees. As your business is growing on the accrual basis, you may have higher taxes. You may have greater compliance expenses, especially if you have additional locations. And you may have additional debt service to handle. Debt service meaning paying principal and interest. So every growing business, as it's growing, can have a cash problem. So what are the top 20 reasons why a startup will fail? Well, what's number 2? A profitable or a startup that could be profitable can run out of cash. It's also true that I believe that SCORE's done some studies, and that in the 4th and 5th year of a business, so a business that has hit the 4th or 5th year, starting to grow, the number one reason that it can go out of business is lack of cash, even though it's profitable. So cash flow is crucial. So focusing on your liquidity is important. Most entrepreneurs are focused on the operations of their business. They're focused on selling. They're focused on satisfying their customer. They may be focused on hiring employees or training employees. But if you ignore your cash flow, it can be a problem. So making cash flow a priority is an important thing for a business owner. Cash flow management. And Terry, if you've got any questions from the attendees, go ahead and interrupt. This would be a good time to break if there are any questions.
Okay, we don't have any right this minute.
Okay, good. Thank you. So cash flow management, knowing when, where, and how your cash needs will occur is important. Knowing the best sources for meeting those additional cash needs is crucial, and being prepared to meet those needs is important. So in managing your cash flow, you need to know when and how much you're going to need, and then you need to anticipate that by being prepared to fulfill those cash needs. So this, if I point up to any slide that we're going to have tonight that I think is crucial for cash flow management, this is it. It's important for business folks to develop cash flow projections. You may be doing profitability and sales projections, but it's important to do cash flow projections. And I would say you do short-term cash flow projections, perhaps weekly or monthly, and have them go out at least to the end of your year. And you should also, when you do your annual planning or budgeting, you should look at your long-term cash needs. Because as you look at your business growing and anticipate the cash needs over the next 3 to 5 years, you should be looking at how you're going to fulfill those needs. Are you going to need more debt? Are you going to need to bring on more partners? Those are things that you want to know in advance so that you can properly negotiate them. But doing a cash flow forecast or a cash flow projection that does a weekly forecast or a monthly forecast is very crucial to running a business. And that's true whether you're on the accrual basis or on the cash basis. Here's a depiction of cash flow. So you get your cash in from receipts from the sales of goods or services, or from if you've got investments, or if you've got loans or people investing in your company. So that's cash flow coming in. Well, where does it go? It goes to your suppliers, to your employees, operating expenses. There it depicts a vehicle. It could be rent. It could be utilities, supplies. And then if you've got interest, if you've got debt, you've got to pay your interest and the principal, and obviously Uncle Sam paying for taxes. So those are all things that you've got to be able to anticipate with your cash flow projection. So we're going to talk about 3 different types of cash flow. And again, Terry, any questions? It's a good time to break at this point.
We're okay right now.
Okay, good. So we got somebody raising their hand with a question.
They need to put it into the chat where it says chat.
Yeah. You use the chat feature and Terry will read out the question to me. So I'll go on until Darius puts his question in. So operating cash flow, another way to look at this is what's your working capital? So operating cash flow comes from your internal operations. So from your sales, it ends up being a receivable. You have to collect your receivables. You may be in a business that utilizes inventory, or you may be in a service business. But if you utilize inventory, you need to purchase your inventory, and then obviously you need to pay for services or inventory. So your working capital is essentially your receivables, inventory, and your payables. So those are things that generate your cash flow. Those are things that are under your control. Investing cash flow. Investing cash flow are from non-operating activities. So where you may have sales or paying for inventory or services, you may be buying fixed assets here. Once again, we depict a truck, or there may be inventory or equipment that you're purchasing.
Rich,
Yes.
can you hear me?
Yes.
Darius has a question. I'm not sure it's covered by this workshop. He's asking about capital funding for buying a business, I guess.
Okay, so capital funding for buying a business is, you're going to have to come up to buy a business. You're going to have equity. That is, you're going to have people who own the business, who are investing cash or goods in the business. And then when you have sufficient equity, you may be able to borrow money, depending upon what your business plan is. If it's a new business, you need to have a business plan put together, and you need to have sufficient equity. And it's going to depend upon the kind of business, but generally speaking, you're going to want to have at least 20% of your initial needs covered by equity. Hopefully that's helpful. But we for this seminar, this is more of, our webinar is more about an operating business and how to manage the cash flow for an operating business. I hope that helped you, Darius. Investing cash flow, as I said, it's for non-operating activities. It can be for the purchase of inventory, or not inventory, of a warehouse. It depicts a warehouse here, or an office, or equipment. Also, if you sell that equipment, you can have non-recurring gains or losses. Those are things that are not part of your operating cash flow. And then the third is financing. That's kind of what Darian was asking about before. Financing cash flow comes from external sources to help build your business up or grow your business. So you either get it from lenders or from investors. Lenders, that is where you're going to have debt. Debt is where you're going to have to pay interest as well as pay the principal back. Usually with investors, that equity goes into the business, and there's not necessarily a promise of that equity to come back, but you may pay what's called dividends to investors. So out of your earnings, you can pay dividends to your investors, that gets them a return on their investment, but they'll still have investment in the business. All right, so the difference between income and cash flow. Profit equals the revenues minus your expenses. If you're on the accrual basis, you're going to accrue for sales at the time you sell the goods, not at the time you receive the payment. You're going to accrue for purchases of services. So in this depiction here, we show $225,000 worth of gross profit. That's based upon the occurrence of a sale, and you probably already had the inventory or may have paid for the services to generate that gross profit. There are going to be operating expenses like salaries, depreciation, rent. All of those things come down to operating income. And then you may pay interest on your loans, and then you have income taxes. So this measures the profitability of your business. So in this case, the income is $30,000. So it's $30,000 worth of income. Cash flow measures your ability to pay the company. So if you look at a traditional cash flow statement, it's going to show income from operations or cash flow from operating activities. So in this example, this company made $124,000, but it may be a growing company, or it may have bad working capital management. They spent $60,000, or they increased their receivables by $60,000. They increased their inventory by $66,000. So those increases in the balance sheet are a use of the cash that you generate. So cash from the operating activities, actually in this case, was only $22,000. If I see that two participants raise their hand, if you would use the chat feature to ask your questions, we can answer your questions. On this example, this company has purchased equipment in the investing activities. They've purchased equipment, hopefully, to grow the business. They've made some other long-term investments. So they've actually used $74,000 in investing activities. And they had bonds that they had to pay. And they've also paid some dividends to their shareholders. So they've used $46,000. So this company that's actually made $124,000 on the income statement, used $98,000 worth of cash. So they made $124,000, but because of the growth of receivables, the growth of inventory, the investment in equipment, and the payment of debt and dividends, they actually used cash. So they'd have to find a way to generate that kind of cash to cover the growth, even though they're profitable. Now, in this particular case, they had $130,000 at the beginning of the year, so they still had cash at the end of the year. But if they continue at this rate, they're going to have to find outside sources to fund this business. Terry, are there other questions? I've seen some things pop up.
Yeah, we have one from Cynthia. She wants to know how much cash should be set aside for repairs.
That's going to depend upon the kind of business that you're in. Depend upon the kind of equipment that you're using in the business. So it would seem to me that, here's something that I talk to on some of my clients, not necessarily for repairs, but if you're doing that cash flow forecast that I talked about, where you're doing a weekly forecast or monthly and you're taking it out over time, it's always good to have resources for 3 to 6 months worth of expenditures, which would include payroll and repairs. If you can have resources to pay that, either have cash on hand or access to debt, or have borrowed money and put it into the business to cover 3 to 6 months, that's always a good rule of thumb.
Cynthia has a driving school, so that, the car is probably a prime asset of the business.
Yeah, so if it's a driving school, I would imagine that repairs are probably fairly often. And what I'm thinking about repairs is like oil changes and tire changes and things like that. It's more maintenance than repair. Hopefully you don't have a lot of repairs, but you'd have insurance hopefully to cover repairs for any damage that some of the students might cause. But you'd want to take a look again at your cash flow forecast, see what your forecast, and the way you can do the forecast is look at your history, go through your bank accounts, look and categorize everything that you're spending your money on, and use that to help you do a projection as to what you're going to spend. So if you've got, say, 6 months worth of history, use that history to project what you're going to do for the next 6 months based upon whether you think you're going to grow or shrink your business, and whether you're going to have increases or decreases to your receivables, your inventory or supplies, and your payables. But again, I would use my cash flow forecast to develop how much cushion I need, either access to having cash on hand or access to cash. There's something called a line of credit, which maybe some of you are aware of, which allows you to set up a borrowing facility with the bank that you don't have to call on until you need it. So if you have a line of credit that covers 6 months worth of expenditures, that would be sufficient without having the cash on hand. Any other questions? Okay. So getting back to this statement here, this cash flow statement, this is a company that's made $124,000, but because they've grown their receivables, they've grown their inventory, and they've invested in equipment, and had to pay off principal payments on bonds and paid out dividends, they've actually used $98,000 instead of bringing in $124,000 of cash flow. Okay. All right. Cash flow challenges. So your receivables are going up. So you have poor collection on your receivables. What could be the cause? Well, it could simply be lack of focus. If you're not looking at your receivables and focusing on those receivables, people say that if you don't measure something, sometimes it's not going to improve. Sometimes
we have some raised hands there.
Sure.
You don't need to raise your hand. Just type into the chat feature. That's how you go. We can't put everybody on a live mic. That's the problem. So just type it into the chat.
Okay. Well, while they're typing that in, I'll talk about receivables again. So it could just simply be lack of focus, or it could be you're afraid to confront your customers because you're afraid of losing them. Well, if somebody doesn't pay you, if they're not going to pay you, losing that customer is probably a good thing. So a sale that doesn't result in cash is not a sale. One of the things that I would recommend on receivables is following up with your customer before their payment is due. So a lot of companies typically will give 30-day terms or 20-day terms where you ship the goods or you perform the service and then you give the customer 20 or 30 days to pay. Well, what I recommend, if you've got the bandwidth, is to follow up with the customer before that 20 or 30 days is up. Follow up 10 days after the sale occurs and just call the customer up and say, did we perform the service? Did you get everything that you were supposed to get that we shipped to you? Was the invoicing correct? Is there anything that we could do, or is there any reason, anything we need to do to help you so that we can expect to be paid on time? So when you do that, sometimes you find out about problems before they come up when the receivable is due. It's a quality check on your team, but it also is a way to eliminate excuses, frankly, as to why a customer doesn't pay on time. The other thing is you should think about your credit terms on receivables. Utilizing credit cards. I realize that a lot of small businesses, credit cards can be expensive. You might be paying 3% to the credit card company. You can also look at prepaid discounts, where if somebody prepays you, you give them a discount on the invoice amount. Or in some businesses, you can ask for a deposit or progress payment. So for instance, if you're in the catering business, I'm working on my daughter's getting married next year, and we're working on her wedding, and there's deposits already for the caterer, for the venue. That's a common practice to make deposits to secure the service. Another thing too is if you're in a business where it's taking a lot of time to perform the service or to perform building something, you can ask for progress payments. So like like Boeing gets progress payments on airplanes many times. Or if you're in the construction business, you can get progress payments based upon things that are completed. Or if you're in a service business, say you're doing software, progress payments in the software business is very common. And what you want to do is on those progress payments is, if you can, cover your cost, not the profit, but say your product or your service gives you a 50% gross profit margin. If you can get 50% of the ultimate sale amount early, you've covered your cost. So that's going to help you very much in managing your cash flow of your business, and it's also going to mitigate risk. So those are some ideas on receivables.
Okay, Lovetta has a question. How does this information relate to days cash on hand, and what reports could be run to keep an eye on cash flow?
We're gonna talk about days cash on hand in a moment. So I'll wait until I bring that slide up. But yes, that's a good question in terms of days cash on hand. We'll bring that up in a minute. Inventory levels for those of you who have inventories, how can you improve on that? Well, one is to have a good sales forecast where you're purchasing inventories as you need those inventories, as opposed to having inventories just in case. So you may have heard of just-in-time inventory. I used to talk about just-in-case inventories, where people buy inventories just in case the sale comes in. Sometimes that's not a smart thing from a cash investment perspective. But another thing you can look at is, if you're a good customer, or if your vendor has increased prices, go back to your vendor and look at renegotiating your terms. So if a vendor's got you paying in 10 days, or a vendor's got you paying in 30 days, and they increase your prices, and the price increase is something that you don't think you're going to be able to push back on, but maybe because you're a good customer, you may be able to renegotiate those terms so that instead of 20 days, you get 30-day terms. Another thing to do with regard to terms is look for an alternative source for your product or your service, because if you have an alternative source, that will increase your leverage in terms of negotiating. Another thing with regard to inventory, and we'll talk about this, is you measure your inventory product turns. How fast does the inventory come off the shelf? A final thing that I'd suggest is, if you're in a business that carries a lot of inventory, and you're not the one yourself as the owner ordering the inventory, it's people who work for you that order the inventory. What I found very effective, especially in distribution businesses, was having incentive compensation. So bonus plans that measure profitability and working capital management. So just because somebody's line was really profitable, if they had to carry a lot of inventory, sometimes the return on investment in that inventory was lower than somebody who carried less inventory and had maybe a percentage fewer sales. So you can develop plans that reward for return on investment on inventory as an incentive plan, and make that part of the compensation. And if somebody's got detailed questions on that, I'll be happy to talk to them even outside of this meeting, because that's something that I've got a lot of experience in developing those kind of plans. Expenses are too high. That could be a cash flow challenge. Well, again, you want to prepare your cash flow forecast and make sure that you understand where your expenses are coming from, and make sure you manage those expenses. One thing that we'll also say is, if you're looking for growth, don't run ahead of your headlights. Don't invest in growth so much that investment in growth with your current cash flow inhibits your business. So the example we give here is, interest from potential customers was very high, so I hired additional salespeople. You need to have a real basis to increase your infrastructure, and do it on a timely basis. Any other questions there?
We have one from Cynthia again. Cynthia with a driving school. In my type of business, what kind of discount would you recommend for a driving school?
All right, so if in your business, one thing you can think about and look at your competitors. Do the competitors ask for deposits up front to secure a time? But if they don't, what you should look at is, how much does it cost you to borrow? So we'll use a real simple example. If your borrowing cost is 12%, 12% comes to 1% per month. So if it's a 12% per annum borrowing rate, it's 1% a month is what it costs you. So if you've got 30-day terms with your customers and it costs you 1% to borrow, you could actually offer a 1% discount for somebody to pay you at the date of the service, as opposed to paying you 30 days later. And that would be a break even if you follow my math. So it costs you 1% a month to borrow money. If you gave somebody a 1% discount, it would be break even. If you gave them a 0.75% discount, you'd be ahead because you don't have to borrow at 1%. You'd be paying 0.75% to get your money up front. So it's going to depend upon what your borrowing costs are and frankly, what your equity costs are. If you have to pay dividends to your owners, that's something that would come into play. But that's a formula. If you've got an accountant should be able to help you figure that out. Or if you want, you can contact me or contact a SCORE mentor and they can help you work on that. Hope that answered the question. So the expenses being too high, you want to look at your expenses, make sure that you're not getting ahead of yourself by bringing in. A lot of times people bring in a bunch of salespeople because they say, well, if I bring in 5 new salespeople, every salesperson is going to bring in $100,000 worth of sales. So my salespeople cost me $50,000. So that's a good move. Well, the question is, how long does it take for that salesperson to be effective? If it takes a salesperson 6 months to be effective and you bring in 5 salespeople, you're going to have 6 months of 5 new people being on the payroll who are not really producing sales. So don't get ahead of your headlights. Do a measured increase to your staff so that you can afford it. I would stagger that hiring. Cash flow challenge number 4, your sales are too low. Well, one thing you can do is revisit your pricing. Are you charging too much? Are you charging too little? Excuse me. Reassess the overall market dynamics. Look at your value proposition. Is it possible for you to be selling to the same customers and have some additional things in your product line? Reassess your sales approach. Something that's occurred. Well, this is. Think about this. Think about retail businesses, the businesses in malls. That whole sales approach in the mall business has been upended by Amazon. So you have to look at your sales approach and say, okay, what's my most effective way to get to market, and what's the most effective way for me to get those sales recorded as soon as I can? You know, electronic sales or e-sales may be a real viable solution for somebody. Any other questions? All right, so let's just talk about the cash conversion cycle for a second. So the cash conversion cycle, you buy or make goods or you provide a service. So you're investing in those goods or you're investing in materials and labor for that service up front. Okay, so that's a use of your cash. Then you sell the goods or services. If you sell them on terms, it's going to take time for you to collect those receivables. So from the time that you initially bought the goods or the service to the time that you collect the receivable, that's time that you have to invest in your business. You're not getting the cash in until you collect that receivable. So you collect the cash, and that's the cash conversion cycle. So how can you improve your cash flow? Well, you can increase your sales, but you do it on a profitable basis, and you do it with enough resources to be able to finance that growth. You might change your sales terms if you can get deposits up front, or if you can look at cash discounts, or frankly, be better at managing your receivables. Don't be afraid to call that customer up and ask them. If you've done the job for them, they owe you the money. There's no reason why you shouldn't be able to call them up and ask them to pay you. Vendor terms. Take the opportunity to negotiate better vendor terms. When somebody increases price, or if you've been a very good customer, ask for an improvement in the vendor terms. Sometimes just trying to negotiate price, which a lot of vendors are going to look at increasing their price, but if you ask them for a change in terms, sometimes you can get the benefit of a change in terms when there's an increase in price. Lower your controllable fixed cost. It could be simply by looking at your facility, saying, do I have more facility than I need? One of the things I think everybody's learning in COVID times is that, you know, some of the jobs can be done from home or they can be done remotely. So if I'm going to have some of these employees out remotely, do I need all of that office space? Do I need all of that space for my factory? Or so look at your controllable fixed costs. Another thing in controllable fixed cost is look at how you pay your employees. I'll use an example. The easiest example is sales, but this can be true for purchasing people. It can be true for marketing folks. If you have a sales incentive plan where your employee benefits based upon their performance, which helps you perform in terms of profitable growth and in terms of good cash flow, that's a win-win. So for instance, with a salesperson, a lot of people will have a salesperson with a salary, and they think, okay, if I get this salesperson to really perform, it doesn't cost me anything more, except maybe a little bit of travel, but I can improve on my margins, and that comes straight down to the bottom line. Well, think about having salespeople that have a lower base salary and then incentivize them on their sales. And another way to incentivize them, if they have some discretion on the sales price, is you incentivize them on gross margin, not sales. So I've always thought that if you have a well-structured bonus plan, you want your people who are on that bonus plan to make a lot of money, because if they're making a lot of money and you structured that bonus plan appropriately where it helps you in terms of profit and cash flow, you both win. So I like to have my salespeople make more money than what they would make on a fixed salary, but they're doing it because they're performing. Another way to improve your cash flow is to reduce your working capital, lower your inventories, negotiate your terms. There's a concept in the construction business where the vendors, the subcontractors get paid when the general contractor gets paid. Is that something that could be appropriate for your business? Look at reducing capital expenditures. For instance, one thing I've looked at many times is a lot of people think that they have to own office space or own their factory. If you're not in the business of being an office space or factory, if you're in the business of selling a service or a good, that's where you should be making your investments. So sometimes it's better to rent space or rent factory than it is to own those things. Any other questions there, Terry? I saw something.
No, we're good for now.
Okay, I saw somebody's hand go up again.
Again, they need to use the chat.
Okay. All right, I promise. Days sales outstanding or receivable days. What I'm talking about here is working capital productivity. You want to measure your working capital management. So it was brought up, somebody asked a question before. You should calculate your days receivable outstanding every month and track the trend. And what the days receivable outstanding is going to tell you is how many days does it take me to collect my receivable, or what are my average days outstanding on receivables? So if you have 30-day terms, that doesn't mean that your receivables are performing at that rate. And you can do a simple calculation, taking your ending accounts receivable by your average daily sales for the period to come up with the day sales outstanding. So you could have 30 days outstanding in receivables. If your terms are 30 days, that's very good management. But if those 30 days start to creep up 30, 35, 40, 45, you've got an issue in your receivables and you need to be looking into it. Another thing to measure is if you carry inventories, is you calculate inventory days on hand. Similar calculation to receivable days, but days on hand measures how many days inventory is effectively on the shelf before it goes out as a sale. So if you count your receivable days and your inventory days and add them together, those are the days that you've invested in your customers. And then accounts payable days. Conversely, if you pay your payables early, a lot of people take pride in paying their payables early. That's not really a good practice in my mind. You should negotiate your terms and use the terms to pay the receivables with your vendors on time. Don't pay them late, or at least warn them if you're paying them late, but try to have good negotiating or good relationships with your vendors. But if you think about it, if you've got 30-day terms with a vendor, use those 30 days, because if you pay them early, you might have to borrow money and pay interest on it. If you pay within terms, accounts payable are basically they're free loans. So if you add up your receivable days, say you have 45 days in receivables. If you have 45 days in inventory, that's 90 days in your assets. And if you had 30 days in your payables, you subtract the 30 days from the 90 days, and that means that you'd have 60 days that you've invested in your working capital or your cash flow cycle time. So receivable days, inventory days outstanding, minus your payable days gives you your cash flow outstanding. You want to track that and see how long, if that's going up or going down, and you want to be able to manage that. But basically, in my example that I gave you, you have 60 days worth of working capital that you have to be able to finance. So it's good to measure these things. You want to measure them on a regular basis, measure them at least monthly, and track them and understand why they're going up or going down. And once you understand it, use that understanding to improve your results. Okay, any further questions? This is kind of a quick summary and focus on things on cash flow.
We have one from Lovetta. How does this slide apply to the nonprofit sector? Our accounts receivable are from donations and grants.
On donations and grants, if it depends upon how you're doing a donation or grant. If they're just single grants that you get periodically during the year, you want to focus on the cash flow forecasting of those things. But if you've got donations that are commitments where somebody says, okay, I'll pay you this much a month, you can track how the collections have been on those donations. In a not-for-profit business, I would want to look at my accounts payable to make sure that we're utilizing the terms with our vendors. But in the case of a not-for-profit group that depends upon donations, if they're one-time donations, the way I would look at that is I would forecast those donations, and then, the people who raise those donations is try to hold the fundraising folks to those forecasts to get those monies in as soon as you can. I'm actually on the board of an entity that depends a lot upon donations, and they forecast their donations throughout the year and track how they're doing against their forecast and their budget on those donations, and they actually try to work towards them. Other questions?
Okay, we are going to put up a feature called polls. If you folks would take a couple of minutes just to fill that out. It's a feedback for us. We'll also stay here as long as you want to answer questions. And if you have more questions, I've recognized some of the names that are here, and I know you have SCORE mentors, but some of the other people might benefit from getting a SCORE mentor, which you can do by going to piedmont.score.org and clicking on Find a Mentor. That will help answer some of these questions or some of these other things that may pertain just to your business.
Yeah, and if you've got questions for me, you can contact either through the SCORE group and they'll get that to me, or you could email me at rpclays, that's rpcleys at gmail.com. rpclays at gmail.com.
And the evaluation is up there now. If you just take a couple of minutes to fill that out, we'd appreciate that. Or if you have more questions, we'll take those too.
Yeah, I'd be happy to answer any other questions.
Lovetta, you might have had another question. You need to restate that. I didn't quite understand what you meant.
Okay, well, if there are no more questions, I think I will sign off. If you can finish the evaluation, that would be very helpful to folks at SCORE and helpful to myself. Thank you.
We have one more from Cy.
Yes.
He wants a phone number. I can give you the number here. It's 864. Well, I thought I could give it to you here. Let me put it on. I'll put it in the chat. Hold on a sec. We have another comment from Lovetta. That was more of a comment to a statement he made. I guess I'm asking how to better track cash flow in the nonprofit sector. Accounts payable has increased.
Okay, so the question is, why have accounts payable increased? Is it because you've had higher expenses, or are you paying slower? I think in the nonprofit, if you remember that one slide that I said was the most important slide, is to do a weekly or monthly forecast. And when I say weekly or monthly forecast, that's how the periods in which you're forecasting. So if you're doing a weekly forecast, what I would say is you do a weekly forecast for every week going out through the end of the year. And you look at what your cash inflows are likely to be every week, and you look at what your cash outflows are likely to be every week. At the top of your schedule, you show your cash balance. At the bottom of your schedule, you show your new cash balance. And you track those things, and you see whether or not you're going to need to have outside cash to help manage your not-for-profit or for your business. Again, that's, to me, of every slide that we showed you tonight, the most important one is get in the habit of periodically doing forecasts of your cash flow. And when I say periodically, you might do them once a month, you might do them twice a month, but you measure your cash flow by week, or you measure it, if in some cases you might measure it by month, but I recommend looking at it by week, because sometimes your payroll, you might, if you pay, especially if you pay once a month, you might have 1 or 2 weeks during the month where you have real cash flow needs because you paid your entire payroll, but you're getting your inflow of cash throughout the month. So I recommend, whether you're a not-for-profit, whether you're a service business, a manufacturing business, any business, is to forecast your cash flow and do it on a weekly basis, and do it throughout your budget period. So it would be from now until the end of the year, or perhaps you do it from now until March. But as you do this, you'll get better and better at it. And it will help you manage anticipating when you need cash or when you might have some excess cash.
Lavetta has another comment. Accounts payable has increased because we have had a higher increase in need, I guess the need of their clients during COVID, but we're working on old grants, waiting on new grants to come in. I have calculated 88 days of cash on hand.
Okay. Well, if you've got additional needs and you're not increasing your revenue, you might look at other ways to cut back on your use of cash. The real thing is, you're going to, because of COVID, if you're going to have some permanent increases to your costs, you're going to have to find some more revenues, or you're going to have to find some way to cut to cost. So you might have to make some very tough decisions with regard to cutting costs. And one thing that people are finding, though, is that because of COVID, they're finding that more people can work from home. And if that's the case, you need all the office space if you have office space. There's a concept called hoteling, where people can share an office or share a cubicle because they're not in the office that often. Public accounting firms, auditing firms use this concept because a lot of times they have their office space where it's very expensive, but they're out with their clients more often than they're in the office. So they actually will not have one office per employee. They'll have an office for maybe 3 or 4 employees, and they share the office. I see a question: is weekly cash flow the same as cash on hand? No, when I'm talking about weekly cash flow is I'm actually saying you forecast what cash you're going to use next week and how much cash is going to come in next week. And then you do the week after that, you look at how much cash is going to come in that week and how much cash you're going to use that week. And you actually show whether you're positive or negative on your cash by week. And that's going to help you manage your cash flow once you start evaluating that. You may delay purchasing, you may try to find ways to increase revenues coming in, or you may have to find short-term ways to bring outside cash in. You may have to borrow. So to help answer, days cash on hand simply says based on your run rate, you've got 88 days worth. But cash use and cash inflow is not flat. It's not equal. There are some weeks you're going to have a lot of cash coming in. There's some weeks you won't have any. There'll be some weeks where, for instance, if you're going to have once a month you pay a utility bill. Once a month you're going to pay your rent. Once a month or once a year you're going to pay for insurance. You've got to put those things in this weekly cash flow and say, okay, what week am I going to pay for my rent? What week am I going to pay for my utilities? What week am I paying for my insurance? And look at that every week to see whether or not you're using cash or bringing cash in, and then track that trend and see what's happening to your cash balance. And that will allow you to figure out whether or not you're going to have to get some outside sources for cash, or you might have to figure out ways of getting more revenue in. Hope that helped.
Okay, if there's no more questions, thanks for coming, folks.
Okay. Out of 100%, how much you invest back in a business? Darius, 100%, how much you invest back in the business? It's going to depend upon what your forecast looks like. If you're growing your business, again, look at your cash flow forecast and see how much cash you're going to need. If you're growing your business, a lot of times you keep all the cash in your business and you don't take it out. When I'm talking about not taking it out, I'm not saying not to take a salary. If you can afford to take a salary, what I'm saying is don't take out dividends. Don't take out money for the shareholder or shareholders. Okay. Thank you.